We are at a critical spot for the S&P. We can see it trying again as we're getting these higher lows. And I think it's important to just note them, that we are continuing to make some progress here. We are continuing to make a low, retest, and then go higher. It's happening over and over again. And I think that's an important distinction. There's some other things that are going on here that we need to address. This was obviously that CPI data. You're trying to flip, and technically you're there. Now what you need to do is to confirm we need that higher high, and we just don't have that yet. So that's what we're looking for. It's the very first thing we're looking for, but we are aware that we're running into a couple key areas. Now the blue line is the 200-day moving average, and we can see how we've responded to that in the past. Since we rolled back down in April, you can see that line right there very, very clearly, right? How we just tried to get over that, and then we're just unable to do so. Trying again here in August 16th. Now there's some data out here that's going to show why this might actually go this time, and we will get into that. But you can see that we need to be watching this 200-day moving average, as we've had problems with it in the past. Now we always look for patterns, because patterns repeat themselves. It's not a guarantee, but it's something that we need to focus on. If we look at the undercut on the CPI and then the rally, you can see that this is technically a double bottom because of the undercut. The problem with this is the confirmation, at a minimum, someone is going to suggest is here. Some are going to suggest it's here. So that's a heck of a move before this, quote, double bottom is formed. But there is another pattern in here. Now, we talked about this pattern in the past, about a week ago, but let's go over it again. So we have this dragon pattern, and right here, there's your head. There's your leg, the hump of the dragon, your second leg, and this part is your tail. Now, for confirmation of this pattern, you need to flip. You're not flipping. Now, we know where the 200 is, but we're not flipping yet. We're just still sitting there. So we don't have confirmation yet. Now, there are two defining factors of this particular pattern. Number one, the volume on the second leg needs to be significantly greater than the selling. So in this case, that's exactly what we have. We have the volume is significantly greater on the buying than it was in the previous selling. This marks the leg, and this gives us the first indicator. Second, and more important, there must be a positive divergence on the RSI. If we take a look right here, we can see the lower low. If we look right here, we can see the lower low. And we can see the higher low. So that is giving us our positive divergence. So now that all those parts are mapped out and all those pieces are confirmed, what now? Now we need confirmation. And how are we going to get that confirmation? First thing we're going to get confirmation from is just by simply flipping this level, which we're just not able to do. And we are aware that we have to be very cognizant of this 200-day moving average. Now, we know that these are issues, and we're going to have to watch them. The confirm is flipping this, but we need to be aware that we're within 1% of this area. Based upon this particular pattern, this hump of the dragon actually becomes your target price. So you can see this pattern pretty clearly after you play with it a couple times. You know the criteria that you now need. So you can actually overlay this in a couple other areas, and it's actually developing in a couple other sectors that I will put together in another video. But we have our target, and we know where we're at, and we know where we stopped last time. So now we have to kind of drill into this and say, is there something else that we could find that might help us get a better picture of what's going on? The answer is yes. This is the S&P stocks above the 50-day moving average, percentage of stocks above the 50-day moving average. Right now, we are at an 88 3/4, let's call it. You can see that we were there Tuesday, August 16th before. Again, Wednesday, April 2021. Back here in April 2021. Back here during the pandemic in June. So it's pretty rare for us to be up here. And essentially this is telling you that about 90% of all stocks are above the 50-day moving average, which is pretty significant. Now, if we overlay the S&P with the percentage of stocks over the 50-day, we can see this line, and we can see clearly that it marks the high, previous, and you just kind of go through and you take a look and see if they had something similar. Well, this kind of sold off here, didn't it? We bounced back up, but nonetheless, we sold off. And you just kind of go through these points and you mark them off and you see what happened. And then you can get an understanding of, hey, this may happen again. So knowing this, we need to have our antenna up. This is the percentage of stocks above the 200-day moving average. Now, as you can see, it's at 58, significantly lower than where we were on stocks that are above the 50-day, which is interesting. But we do have one little distinction here. We made a higher high. Previously, we did not make a higher high on this rally. So we have a data point that's a little different that's showing that the breadth of the market is actually getting wider. Now, what we'd want to do is we'd want to see if there's any kind of correlation with when we're making a higher high, if that equates to higher equity prices. So we can see the disparity here pretty clearly. You can see this peak. You can see how we're acting at that peak after here. And now you can see that the percentage of stocks is above the 200-day moving average versus this peak, and the S&P's lower. So the breadth is wider on the market, but the equity prices are lower. So that shows broad-based buying. Now, the previous indicator did show that maybe we could pull back, but that doesn't indicate that we're just going to fall off a cliff. So what we would do is then extrapolate out and look at this and say, were there any other higher highs like this over the course of time that we could look for? Well, here marks a peak, and then here marks a higher high. And if we look at it from that perspective, from the peak to the higher high, you can see how this played out, and we got higher equity prices. And then we just kind of go through this repeatedly and see if we can find similar situations. Here we are in 2018, where we make the higher high. And if you take a look from that point on, we push higher. So now we're aware of the breadth of the market, how it's widening, how we might be a little overextended. But then we take a look at the put-call equities ratio. And we can see that we were just as high as 1.52. And then you kind of extrapolate this out and go, geez, when was the last time we were this high? Well, you would have to go back to this date. Now, if you go back to this date, that's going to take you to March 2022. So that's pandemic level buying. And from that time on, you can just see the absolute collapse. And you can see roughly where we're at. Now, if you take these dates and you overlay the movement on where we were at during that period in time, let's put this up here, because obviously no one's going to catch the bottom, no matter what they say, right? And then you look at where we're at right now, and you can see that we dropped. But let's just call it here to put it in perspective. So we have the same kind of reading here on the put-call ratio that we had here. Now, it always helps to zoom out a little bit and get a sense of where we're at. So you see the put-call ratio that we're giving the same reading on is right here after this particular kind of drop. So when you take a step back and you look at this drop and you compare it with something like this, we see a drop of about 34.28% from when the pandemic started to ending the sell-off. This was the complete pandemic selling. It took about 2 months. Now, from our peak to where we are right now, from the low, you're at about 28%. So it's not as deep as it was before, but it's comparable. Now, take a look at where we are in regards to the 50-month moving average and look at how we continually bounce off here, 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 here. The only time we didn't was the great financial crisis. Every other major event that got us down to these levels, we bounced off of. So I think there's enough data out here to suggest that we could continue to bounce. And the first step of this is going to be watching that dragon pattern. The trading community is on waitlist. If you are interested in joining, simply click the link here in the top right and you'll be added to the waitlist. You'll also be signed up for the free newsletter. Trade to win.